According to supply managers in the 9 Mid-America states, how is the economy performing?
Our survey for the month of June, released today, the first business day of the month of July, indicates that the Mid-America region, according to supply managers, manufacturing supply managers in 9 states, the overall index dropped from 58 to 58.6 from 60 in May. So things are slowing down, but we're still seeing growth out there according to the supply managers. Now, we asked the supply managers about looking ahead if they expected a recession, and fully 1 of 4 expect a downturn. Only 19 expect healthy growth. The remaining 58% expect flat growth. Now, when you come up to the overall probability of a recession, the estimate over the next 12 months was 69% likelihood of a recession according to supply chain managers in manufacturing. Now, a good thing about the survey for this month, the supply chain disruptions were somewhat better, so we're seeing fewer and fewer disruptions in the supply chain. Now, let me bring up the overall graph charting the overall survey results, and you'll see there quickly that it's the overall index continues to decline, moving into slower and slower growth, much like the national number, although our Mid-America regional number is above the national ISM number, which will come out later on this morning.
What were the hiring trends?
Hiring was up. The overall the reading was the hiring reading was 59.7, and that's up from May's 53.4. So that's a good reading. However, the regional economy still is below pre-pandemic levels. That's non-farm, seasonally adjusted employment is 1.5% below the pre-pandemic levels. The U.S. employment level is only about 0.5% below pre-pandemic levels. Only South Dakota and Arkansas, among the 9 states that we survey, have seasonally adjusted non-farm employment above pre-pandemic levels.
What inflation trends are you noticing?
Inflation continues to run very hot. Now, the overall index for the inflation reading was down to 88.0, but again, these indices all range between 0 and 100, so 88.0 indicates significant inflationary pressures in the region, in manufacturing region. Now, that's down from May's 91.7. I expect inflation to remain above 8% over the next couple of months, but I think we will see a softening. We will see softening inflationary pressures in the months ahead, but it's still too high. We're well above the Fed's target of 2.2%. We're not going to reach that until well into 2023, if then.
What is the economic outlook?
Inflation will remain above 7% for the rest of the year. I expect that. That's year-over-year inflation. It will drop to that by the end of the third quarter of 2022. Right now it's above 8% year over year. Now 7% is an improvement for that. Economic growth will continue to slow but remain positive. Supply chain disruptions will ease up a bit, but still too many out there. Supply chain disruptions, the length of time to get inputs, still too long. Short-term interest rates will rise by another 1 percentage point by the end of quarter 3 of 2022. So we're going to have a Fed rate hike in July of 0.75 percentage point. Then we'll have another rate hike in September. I think it's going to be lower, maybe 0.25%. So we're looking at that. Short-term interest rates, again, will rise by another 1 percentage point by the end of quarter 3 of 2022. The prime interest rate as well will rise from its current 4.75% to 5.75% by the end of quarter 3 of 2022. Long-term interest rates, that would be mortgage rates, and that's really unfortunate. We're seeing mortgage rates rising from, say, I expect rising from current 6.2%, 6.1, 6.2% to over 7, and I expect 7.5% by the end of 2022. That's just reflecting the inflation, upticks in inflation, but also the Federal Reserve's policy of quantitative tapering. So we're seeing that tapering having an impact. And in terms of what to keep an eye on the bond market. That's telling you a lot of things that economists would hope to tell you. In other words, the 10-year Treasury, that yield is now running between 3 and 3.2%. When that yield moves below 3%, that's telling you the economy is slowing down. When it moves above 3.2 to 3.3 to 3.4, that's telling you inflation is the main factor. So again, that's the real benchmark to keep an eye on. If is it a recession or is it rising inflationary pressures? Also keep an eye on the employment report, which comes out later on this morning. I expect that employment report to still be positive, but not nearly as positive as we've seen in prior months. Keep an eye on the price of a barrel of oil. That price has been moving lower, and that's a good thing for inflation. That's one of the reasons I'm expecting inflationary pressures to slow in the weeks and months ahead. And I think the most important thing to keep an eye on or listen to is listen to the Federal Reserve governors. The governors have just indicated this week, in fact, one of the governors indicated that she's on board with a 0.75% increase in the funds rate, short-term interest rates in July. That will be done unless something changes dramatically between now and the end of July when the Fed meets, the Open Market Committee meets again. That'll tell you more than Ernie Goss or any other economist is going to tell you in terms of interest rates, and also tell you what's going on with the overall economy, U.S. economy, but to a large degree the regional economy as well. So that's our survey for the month of June here at Creighton University, coming to you from beautiful downtown Omaha, Nebraska. Until we meet again on the first business day of August, may your economic cup runneth over, and thank you.